All right. What's up, YouTube? And what's up, Cash Flow and Grow podcast? This is the Q&A section of our podcast. We're going to do some stories where we do founder stories and interviews of actual business owners. And then sometimes we're all just riff and share some opinions about business or an update to the tax code. And other times we'll do Q&A where I'll take your questions from either Instagram or other social media platforms, or you can email your questions to tyler@tylermcbroom.com and we'll get them on the podcast for you. So let's dive into it. All right, so question number 1. Please briefly explain Section 179 for 1099 income earners. Can you do Section 179 every year, specifically on top of that? So first off, what Section 179 is it's a form of depreciation that allows you to accelerate depreciation. So when you go and buy and it's most commonly used on a vehicle. So let's say normally you go and buy a vehicle. If it's a $50,000 vehicle, you take the purchase amount and then you spread it out over 5 years. You get to take a little bit more in the early years and a little bit less in the later years. But with Section 179, if it's an SUV or a truck that's over 6,000 pounds, then you can take 100% of the business use portion of the purchase price of that vehicle or any other large piece of equipment in the year you purchase it. Now, if it's an SUV specifically, there's some limits to the amount you can take, and those change a little bit every year. But if it's a truck, like a large work truck, you can take 100% of the business use. And then if it's a piece of equipment, let's say it's a crane, your manufacturing equipment, you can take 100% of that in the year you purchase. Now, you cannot take Section 179 deduction for a loss. So if you have a $50,000 Section 179 purchase, but only $40,000 of profit, you're limited to $40,000 on that in terms of the current year. And then whatever's left over just carries forward into the next year. As far as being able to do it every year, you can, as long as you buy a new piece of equipment or a new vehicle every year. Now, if it's a vehicle and you're trading in your old car for a new one, and you took Section 179 and fully depreciated it in a previous year, then you would have to pay tax on the sale price, but then you'd get to depreciate the new purchase price. So it's not as sweet as the first year you ever purchase a vehicle. So that's how that works on Section 179. The other option that's kind of related to it is called bonus depreciation. Bonus depreciation functions in a similar way, meaning you get to accelerate a large chunk of the purchase price in year one. Bonus depreciation you can take for a loss if it works out that way. But in 2024, it's limited to 60% of the purchase price in year one, and then the rest balances out. Now, they're talking about possibly retroactively bringing it back to 100%, which is what it was for a long time under the Trump tax plan when he first came into office, that's expiring in the next couple of years. But for right now, it's 60% that you get to take in year one. All right, so that's Section 179. The next question is, can you write off business meals when it's a remote meeting? And I'm assuming this means over Zoom. And the answer is having a meal and scarfing your face or stuffing your face while you're on a Zoom call does not make that deductible, unfortunately. So working from home, eating your snacks at home while you're on a Zoom meeting does not make it deductible. It's got to be actually traveling. If you're eating by yourself, traveling overnight somewhere that's for a business trip, then those would be deductible. Or if you're in town, it's got to be a business meeting with somebody else, and there's a business purpose to that meeting. So whether that's a prospect, a client, a vendor, some sort of mentor or coach, it's got to be an actual in-person meeting. It can't be food eaten over Zoom. Next, will any tax changes that the Trump admin proposes have an effect on 2024 tax returns? So the only thing that I could see possibly impacting 2024 would be if they do that retroactive 100% bonus depreciation. And if that's the case, it'd be more what happens in Congress while Biden's still in office. if you go back to when Trump first took office back in 2016 and look at that timeline, because the tax code got overhauled pretty significantly then, he took office at the beginning of 2017, and then it took all year working with Congress to figure out what the changes are going to be. Those changes were signed into law in the last month of 2017. So literally it impacted about the last 2 or 3 weeks of 2017 and then mostly 2018 and beyond. So I would expect any changes that come about this time would be along a similar timeline. Okay. Next is, if I'm starting an e-commerce business from the ground up, which state would be the most tax advantageous? So that's going to be pretty much your business-friendly states that have no state income taxes, which would be Florida, Texas. Alaska has no income taxes. Tennessee has no income taxes for the state, but they do have some business-specific taxes that don't make it quite as favorable. There's a few other states, but those are the big ones that have no state income tax. But the key is you can't just open an entity filed in that state and think that you're going to avoid state income taxes if you live somewhere else. You have to actually go move to that state and operate out of that state in order to take advantage of that. And so, this whole business about forming a Wyoming LLC and running your business to like hide income from California or another high income tax state doesn't work like that. They're still going to come after you, and you've got to report that income in the state where you operate. So you want to make sure that it fits your lifestyle to move somewhere that's no state income taxes as well. Make sure that I've got my audio recording here. Computer shut down for some reason. All right, still going. Cool. All right, will entertainment expense ever come back? And the answer is maybe. So entertainment expense used to be meals and entertainment were 50% deductible, which meant if you spent $100 on meals or let's say, ballpark tickets, bringing a client to a game, then you would get a $50 deduction against your income on that. When they passed the Tax Cuts and Jobs Act, aka more famously known as the Trump tax plan, even though Congress wrote it into law and put it in and passed it, they eliminated entertainment. Meals were still deductible at 50%, but the actual ballpark tickets or the greens fees for golfing were no longer deductible. That tax law, specific set of tax laws, expires at the end of 2026 unless it gets extended. So unless something changes, now we've got Trump coming into office. Who knows what the tax law is going to look like in the next year and a half? As I mentioned before, it's going to take a little bit, and we'll find out. But if nothing changes as far as extending the Tax Cuts and Jobs Act, then we will see entertainment expenses come back in 2027, which might be pretty exciting. Can employee incentives and rewards programs be tax deductible? The answer is yes. Now, there's a certain provision actually in the tax code that allows you, if you have a written employee reward program, that you can give them for recognition up to an average of $400 per quarter per employee, and it's tax-free to the employee and a tax deduction not subject to payroll taxes to the business owner. Normally, if you give an employee a gift, let's say a birthday gift or a Christmas gift or any other gift throughout the year, that's actually because they're your employee. Giving them a gift is actually considered wages. So the value of whatever you give them technically has to be added to their paycheck and subject to payroll taxes. But if you have a written policy for employee benefit awards up to $400 per quarter per employee, those can be tax-free. So it's a nice way to get your employees some tax-free value. Now, they can't be it can't be cash. It can't be gift cards. It has to be a tangible good that you're giving them. So like we gave one of our employees a while back a Yeti cooler, or if you've got some gift baskets that you want to give them, you give them a bicycle for their kids or something like that. So it's got to be tangible goods that you give them up to $400 average per employee per quarter. All right. One final question, and this is kind of a follow-up, different person, similar question. Can I open an LLC in a more tax-friendly state to put fixed assets into? You can do that, but there's got to be a business purpose for that LLC. So if you put the assets in there, you would maybe separation of liability for the assets versus your business income. But then you would pay rent to the fixed assets company. If you're still operating that company from your home state that is a high income tax state, you're still going to have to file that return in that state just like that, even if it's just the fixed assets. So you'll want to actually move there and operate from there. All right, that is the questions we got right now. If you've got any questions, tax questions or business questions that you want answered, email them to tyler@tylermcbroom.com, or when you see a Q&A on my Instagram, which is @tylermcbroom, if you follow me there, then plug it in the Q&A box or throw them in the comments on YouTube on the episode, and we'll get those in the queue to get answered. All right, if you found value in this, please share it out to your friends, share it out on social media, and we'll see you next time on the Cash Flow and Grow podcast.